According to CME warehouse stock data, registered inventories available for immediate delivery now sit at 11 million ounces. Total, globally. That's what's left to satisfy a 251 million ounce short position. Think about what it takes to get someone holding physical silver to sell right now. Industrial users need it for solar panels, electronics, EVs. They're not selling their strategic reserves while supply chains are collapsing. Asian investors watching Western paper markets break in real time? They're buying, not selling. Vault inventories already pledged to existing delivery requests? Can't sell what's already claimed. The short sellers need hundreds of millions of ounces. The available pool is measured in single-digit millions. That's not a market. That's a hostage situation where the kidnappers just realized their captive escaped 3 days ago. When Sunday night comes and those screens light up again, you're going to see something that hasn't happened in modern commodity markets. Price discovery without inventory. A gap that isn't caused by news or sentiment or technical factors. A gap that exists because the mathematical foundation of the market just collapsed. Someone holding a massive short position is going to look at their screen Sunday night, see Asian physical markets already trading $15 to $20 higher than Friday's New York close, and make a choice. Cover at a devastating loss now, or wait until Monday morning when the entire financial world watches the price jump in real time, and the loss becomes unsurvivable. This wasn't an accident. The margin increase, the timing, the 52-hour blackout while Asian physical markets keep trading. This was the last chance for the big players to find an exit before the building burns. The CME gave them one final weekend to locate metal, cut deals, and somehow cover positions that mathematically cannot be covered. The problem is simple. There are no exits left. The vault doors are empty, the mints are dark, the export bans are in place, and somewhere right now, in boardrooms from Manhattan to London to Singapore, people who've spent their entire careers trading paper promises are realizing that physics just trumped finance. Welcome to the weekend the silver market broke. 30 hours left on the clock. And when Monday morning comes, the price you see on your screen won't be a number someone decided was fair. It'll be a confession that the emperor never had any clothes. The invisible clock is ticking, and the whole world is about to hear it strike midnight. Now, let's talk about why those vault operators are saying no. Why the banks can't find the metal they desperately need. Because while you were watching the paper price freeze at 103.45, something historic was happening in the physical world. A divorce, a mutiny, a complete separation between what the contracts say exists and what actually exists in reality. This is the part the mainstream financial media won't touch. Because once you understand what's happening to physical silver right now, you realize the entire derivatives market is built on a foundation that's already crumbled. Let's start with China. Because what China just did isn't policy. It's economic warfare dressed up as industrial strategy. On January 15th, the Chinese government implemented what they're calling temporary export restrictions on silver and silver compounds. Temporary, that's the word they used publicly. But here's what you need to understand about Chinese industrial policy. When Beijing says temporary, they mean until further notice. And further notice means until they've secured every strategic advantage that restriction provides. Think about the timing. Silver hits all-time highs. Western banks are desperate for physical metal to cover short positions. And suddenly, the world's largest silver producer slams the door shut. According to the China Non-Ferrous Metals Industry Association, China exported roughly 4,000 metric tons of silver last year. That's about 129 million ounces. 129 million ounces that just vanished from global supply. But here's the part that should terrify you. China isn't restricting silver exports because they want to manipulate prices. They're restricting exports because they need every ounce for themselves. Solar panels, electric vehicles, semiconductors, advanced weapon systems. Every single technology that defines 21st century power requires silver. And China just looked at their strategic roadmap through 2035 and did the math. Let me give you the numbers that explain Beijing's calculus. A single solar panel uses approximately 20 grams of silver. China is installing solar capacity at a pace that requires roughly 4,000 tons of silver annually just for domestic photovoltaic production. One electric vehicle uses between 15 and 30 grams depending on the model. China produced 9.3 million EVs last year and plans to double that by 2028. Every 5G base station, every AI data center, every advanced missile guidance system, they all need silver. The Chinese Communist Party looked at their strategic technology roadmap and realized silver isn't a precious metal anymore. It's a national security asset, and they're hoarding it the same way America hoarded oil reserves during the Cold War. This is the silver iron curtain, and it's not coming down when Western banks need it to. China spent the last decade buying physical silver while Western institutions sold paper contracts. Now they're weaponizing that accumulation. Every solar panel factory in Xinjiang, every EV battery plant in Shenzhen, every semiconductor fab in Shanghai needs silver. And Beijing just guaranteed that none of it leaves Chinese borders. You want to know how serious this is? Talk to the people actually trying to buy physical silver right now. Industrial buyers in Europe and North America are facing lead times that have exploded from 2 weeks to 8 weeks. Some dealers aren't even quoting prices anymore because they can't guarantee delivery. The Swiss refineries that used to process Chinese silver for Western markets, they're scrambling to find alternative sources that don't exist. And then there's the U.S. Mint. America's official silver coin producer just went dark at the worst possible moment. On January 20th, the Mint announced temporary suspension of American silver eagle production due to blank supply constraints. Translation: they can't get the raw silver needed to strike coins. The United States Mint, backed by the full faith and credit of the U.S. government, cannot source enough silver to meet demand. Let that sink in. The entity that's supposed to represent American monetary sovereignty and precious metals just admitted they're at the mercy of a supply chain that's completely broken. And this isn't a production issue. It's a sourcing issue. The silver exists somewhere in theory, but the Mint can't access it at prices that make sense, or perhaps can't access it at all because the metal is locked up in vaults allocated to industrial contracts, or sitting behind China's export ban. This isn't a supply disruption. This is a geopolitical restructuring of commodity flows happening in real time. And it's happening during the exact weekend when Western banks need metal more desperately than at any point since 2011. Now let's follow the metal that's supposed to exist in Western vaults, because this is where the story gets really ugly. December 2025, the COMEX registered silver inventory, the metal actually available for delivery against futures contracts, dropped by 47.6 million ounces in a single month. 47.6 million. According to CME Group warehouse stock reports, that's the largest one-month decline in registered silver since they started publishing this data in its current format. The financial media called it seasonal inventory adjustment, industrial offtake, normal market operations. They're lying, and the proof is in what happened to lease rates while that metal disappeared. When 47 million ounces of silver leave the registered vaults, someone is taking delivery. They're not rolling contracts forward. They're not settling in cash. They're demanding metal with serial numbers, loading it onto trucks, and moving it to private storage. That's not seasonal. That's a bank run on physical reality. And here's the detail that exposes the whole charade. While registered inventory dropped by 47 million ounces, eligible inventory, the metal sitting in COMEX vaults but not available for delivery, barely changed. It just sat there. Why? Because the people who own that eligible silver watched registered inventory vanish and thought, I'm definitely not making my metal available to these desperate banks at current prices. Think about what that means. There are roughly 260 million ounces of eligible silver sitting in COMEX vaults right now, but it's not for sale. The owners know what's coming. They know the banks are trapped. They know the paper price is a lie. So they're waiting for the moment when desperation turns into panic and the real price discovery begins. This is the vault hemorrhage, and it's accelerating. Every day, more metal gets reclassified from registered to eligible or simply withdrawn entirely. The people who control physical silver are voting with their bars. They're saying, I don't believe your paper price anymore. Show me what silver is really worth, and maybe we'll talk. Here's another smoking gun most people are missing. Retail premiums. Go to any major bullion dealer's website right now. The paper spot price says $103.45. But try to actually buy a physical ounce. You're paying anywhere from $12 to $18 over spot for a basic round or bar. For American Silver Eagles, if you can find them, premiums are running $25 to $30. That's not a premium. That's a different market. When premiums hit 30% above spot, you're not looking at a temporary supply-demand imbalance. You're looking at the early stages of a two-tier pricing system, where paper and physical completely decouple. The dealers know it. They're pricing physical silver at levels that reflect actual scarcity, not the fantasy price trading on COMEX screens. And here's what should really concern you. Some of the largest online dealers have started implementing purchase limits, not because they want to limit sales, but because they physically cannot source enough inventory to meet demand. SD Bullion, APMEX, JM Bullion, these aren't small operations. These are billion-dollar businesses with deep industry connections. And they're rationing silver like it's a wartime commodity. Meanwhile, back in the paper market, those lease rates we talked about earlier, 8% wasn't the peak. By Friday morning, before the markets froze, some London dealers were reportedly quoting lease rates above 12% for immediate delivery of large quantities. 12% to borrow silver for 30 days. Let me put that in perspective. The last time silver lease rates hit double digits was during the 2011 squeeze when silver briefly touched $50. But even then, lease rates peaked around 9% and only stayed elevated for a few weeks. We're at 12% with silver at $103, and we've been climbing for months. This isn't a normal tightness in the lending market. This is a mathematical proof that the banks are trapped. Because lease rates are determined by supply and demand for physical metal in the lending market. When banks need to borrow silver to cover short positions or maintain hedge book ratios, they pay whatever rate the lenders demand. And right now, the lenders are demanding payday loan rates because they know the banks have no alternative. You want to see real fear? Look at the term structure of lease rates. Normally, longer-term leases are cheaper than short-term because the lender has more certainty about return, but right now, according to London Metal Exchange data, the curve is inverted. 30-day leases are more expensive than 90-day leases. That inversion screams one thing. The market believes the crisis is immediate, not distant. Whatever's going to break is going to break in the next few weeks, not months. Every major bullion dealer knows this. Every vault operator knows this. Every industrial buyer knows this. The only people who apparently do not know are retail investors still watching CNBC talk about silver as a commodity play. But here's the most important thing you need to understand about this physical mutiny. It's not just about China and vaults and lease rates. It's about trust. The social contract that makes paper contracts work is simple. You sell me a promise that you can deliver metal, and I trust that if I ever demand delivery, the metal will be there. That contract just broke. Not because of regulation or policy, because of mathematics. There are 356 ounces of paper claims for every ounce of physical silver in registered inventory. Even if only 5% of contract holders demand delivery, the system collapses. 5%. That's not a crisis scenario. That's a rounding error in contract holder behavior. And somewhere in Shanghai right now, a Chinese industrial conglomerate is looking at this math and thinking, why would we ever sell our physical silver when Western banks are this desperate? Somewhere in Singapore, a private vault operator is getting calls offering premiums that would have been considered illegal manipulation 3 months ago. Somewhere in Zurich, a refinery that used to process silver for delivery into COMEX vaults is quietly telling their best clients, we're keeping production for spot market sales until this resolves. The physical world is seceding from the paper world. And the paper world is about to find out what happens when promises meet reality and reality wins. Sunday night, when those screens turn back on, we're not going to see a normal market gap. We're going to see the price discovery that happens when the paper lie finally admits it can't deliver the physical truth. The banks had 52 hours to find metal. China said no. The vault said no. The lease market said, you'll pay whatever we demand. And now the invisible clock is down to 24 hours. The physical mutiny is complete. And Monday morning is going to reveal just how badly the empire miscalculated when they built a 356-to-1 leverage ratio on a metal that just became impossible to buy. Here's